Okay, so now we are able to reach the fifth chapter of the book, which is about trading in financial markets. So today we will see how the different markets are operating, which are relevant for us because this is the basis of the derivatives, and practically today's class will describe uh, which kind of derivatives we will analyze during the rest of the semester. So we will see different vanilla and non-traditional derivatives, and later on we will see that how can we use them in risk management. Okay, so reasons of trade. So these are basic facts that why people are going to markets, and practically one of the motivation can be risk management, other motivation can be that they are thinking that there is a direction on the market which can be exploited for profit making, and of course we can find mispricing opportunities to look for arbitrage, or simply you have needs, you need some kind of assets, you need some kind of liabilities, so yeah. And at the end of the day, this will describe that what kind of instruments will be used, how trade will be done, and of course what kind of ways will be used to do so. And if we are comparing the different markets, so organized markets are the traditionally are the exchange traded markets, but nowadays, so during the last 20 years, OTC markets, so many products are going or converging towards exchange traded markets as well. So mostly if we would like to distinguish, then exchange traded markets are behaving much more like as a retail oriented platform, while OTC is much more like a wholesale, to be honest. And what matters a lot that nowadays we can find only electronic trading. So yes, there was in the past some very open outcry, but since the 90s, since the end of the 90s, we cannot find it anywhere at all. But what matters a lot that bid and ask price, the margin or the difference between that, so the spread, can be really important for us because if we are checking the spread and also the turnover of the market, so the liquidity which is running back and forth, then it can determine what is happening at the market. So of course, yes, you could say that, come on, the technical analysis is building on the bid-ask patterns, but in other reasonable cases still we can say that we should analyze this one. And if we are going further, then we can find also clearing houses, and clearing houses are really important because they can remove at least some part of the partner risk from the table. So what we can see here that they are determining the margins, the collateral requirements. It can be cash, it can be marketable security, it depends on the situation and the product and the actual clearing house. And at the end of the day, they can practically, on one hand, they are securing traders against partner risk. On the other hand, it creates an additional kind of a cost. So not a cost, because practically just a capital allocation for this kind of purpose, because you don't have to spend it, you just have to keep the money, the collateral there. So sooner or later, if the position is closed, then you can get this money back. But still, this is the non-transparent part what I don't like so much. But on the next slide we will see that how does it look like. After that, the second section in this main chapter is about positions. So how can we take up long positions, short positions on the market? Short position is trickier, because in the case of long, I'm buying it and then I'm sitting on it and I'm expecting an increase in the price. So this is simple stuff. So in a more complicated way, we can say that we can create a long position through buying on margin. So we're borrowing up some assets, and then we can say that if asset value falls by 25%, then we can increase the collateral. So even here we can have some kind of leverage, obviously, but not in traditional long positions. You can have the option, but usually it can happen at the future markets, when long can be much more popular from leverage. And that's why it can be dangerous, because in case of failure, it can be a problem. Okay, in the case of short, this is when players are trying to defend themselves against the decreasing asset prices, or especially if they are able to say that, okay, this country or this company has weak fundamentals. So even if the company in the weak country has good fundamentals, if terrible news are coming from this country, then share prices will go down. Which is a nice thing. That just the problem is that you need a lot of leveraged positions here, because first of all, you need someone, so you need a broker, because you have to borrow the shares from another client. So the broker should have this share from someone who has a long position, and in their account they already have this, and after that selling this thing, and after that when the price goes down, then buy it back and give it back physically. So the problem is that first of all you need someone who has this share, and also you have to be able to buy it back at a cheaper price, otherwise this contract will not work at all. And also due to the higher partner risk, then you have, at least the book says, provides us some numbers here. So it says that half of the margin or the position will be covered with the margin. So around 150% of the value will be. And now, derivatives. So as you can see here, there are the plain vanilla contracts. And also in Matlab, when we will check the different functions, we can set not just vanilla contracts. So there will be a specified switch which says that it's vanilla or non-vanilla. So why is derivatives? Obviously because the value of the contract derives from another more basic market variable. So yeah, it follows the price of some other asset, or underlying asset. Yeah, that's the right term. And it can be exchange traded, it can be OTC market traded, sometimes it can be both. Sometimes it depends on that you can buy options, but you are not able to write out options, or so it can be a really strange combination. That's why making a difference between OTC and exchange traded markets, I think sooner or later it will be outdated. So the right phrase would be retail market and wholesale market. But okay, the book uses this, so let's keep it. And also, if someone needs data about OTC markets, the book says that Bank of International Settlements provides something, but I can't remember. So sometimes I'm checking the database of the BIS, and you can find cross-border lending and other cross-border banking kind of databases, but maybe swaps, but that's all. So I don't know what was or why it was suggested that OTC markets are, maybe they are monitored by the BIS, just it's not provided at their official website for free. Okay, so what is important for us that the principal depends on the value of the underlying asset, and what matters to us is that how can we determine the value of the contract. So we will do this for the next weeks. So and what are the plain vanilla contracts? Swap contracts, forward contracts, future contracts, options. So everything what we learned at introduction to international financial management class. Okay, so forward, they are OTC. So futures, as you can remember, are market-based. Forwards are OTC. This is the wholesale, this is the retail, and in this case, company A takes a long position to buy the underlying asset for a certain time or for a certain specified future date for a certain specified price. And in the case of short position, they are agreeing to sell with similar parameters. And what is really important here that this is an obligation, so you are not able to step backwards. But from pricing point of view, they are completely the same. So it doesn't matter for us that we are talking about futures, forwards. From calculation point of view, this is just a technicality. So it doesn't matter. And usually forward contracts can be used, as also we learned last semester, to hedge foreign exchange risk. So if we already have the contract that we should deliver something in a determined time period, then obviously we can do this hedge right now, and after that the company is now free of the exchange rate risk. Just the problem is that you know that still we have margin requirements. So maybe we are free of the exchange rate exposure, but we are not free of the volatility exposure, because we know that if volatility increases, margin calls or margin requirements can increase. So practically we are back at square one. Just maybe the exposure is smaller, but now it's related to volatility. So I hate forward and future markets, that's why, because it provides us the false, completely false illusion of security. Okay, and futures. So even there is a comparison between them, forward and futures, so we can see that yes, private, wholesale market, and exchange traded, and standardized, not standardized. But practically main benchmark is always the futures, and they are just in the forward contracts they are following, and maybe they are changing some premiums, but that's why we need futures markets at the end of the day, because they are providing us benchmarks. So if we don't have benchmarks, then it would be really hard to create contracts in the forward market as well. And also, when we have to talk about margins, so this is where practically is described how margins are structured. So there is just the initial margin, which is defending ourselves against the default of the partner. There is also a guarantee fund. There is the variation margin, so daily gains and losses. So this is against volatility. And after that, maintenance margin. This is requested by the brokers. So I mentioned already that clearing houses can define their margins, and after that it can be increased further by the broker house, and this is, we can see it here. And of course we can have physical delivery, or we can close it down before the delivery once is reached, or sometimes they are just offsetting, so or rolling it forwards. So, okay, swap contracts. in this case, we would like to move between two assets. And one way is, or one form is the interest rate swap. When we are saying that, okay, I don't like my fixed interest rate, so I would like to have floating rate, or I really I would like to have fixed interest rates instead of floating ones. So in this case, they are looking for two companies who needs the same, completely the same principle, or at least they are converting until the same principle is required. So at the end of the day, they just have to exchange the interest rates and interest payments. Practically, the entire thing will be an enormous present value calculation to see that interest payments, how can they be balanced, and what is the balance at the end of the day for company and company B. And I have a beautiful Matlab script to do that. So Matlab has already a built-in set of functions, so at least you have to go through 4 steps or 5 steps to reach the value of the swap contract, but also you can do this manually. And even if sometimes it can be that the payment timing can be different, so it can be monthly, it can be quarterly, it can be annual. Sometimes also it can be floating to floating, fixed to fixed. Fixed to fixed has no meaning, but so there can be different approaches. So if we are checking, for example, a Refinitiv database, then hopefully I can find this. Yeah. So we can see here that fixed to float, float to float. Okay, fixed to fixed still. Okay, just I was making it up. It can be linear amortization, so we can have many also cross currency. So there are many different approaches. You can see that bond bases to different maturities, we can set them, and practically we have to price in the first leg, and also we have to price in the second leg. So and after that, it doesn't matter that we are using the Matlab or this platform or other. This one can be completely easily modeled also in Excel as well. If we just need time to do that. No other things are necessary. Yeah. The problem is, or the trick is here in real life, that you have to look for another partner, or you have to create a portfolio which emulates the other partner. So, and if someone works, for example, at Morgan Stanley, there is a whole department just to deal with swaps. Once they wanted to hire me, so I was able to improve my classes based on the interview. Okay, and also we can have options. Call options, put options, so if I would like to have the right to buy, or I would like to have the right to sell an underlying asset at a certain price and certain date, we know that in this case this is an asymmetric position, unlike the futures forward contracts, which obligates both parties. In this case, we are paying the premium or option fee to provide us this opportunity, and the other setter or the other partner must be able to deliver. And yeah, so sometimes books are using expiration date, sometimes maturity date. I will use maturity date and also strike price, not the exercise. Expiration date and exercise price, I would not able to pronounce it. And American options and European options, as you can see, that any time can be exercised, and practically the equation looks disgusting in the case of American options. So this is that long. European option, then you can only do the or execute the option at the expiration date. This can be modeled in a really simple way. So that was the Black-Scholes and its derivatives or different forms of the Black-Scholes function. But on the other hand, the American option provides you completely the same results if the share is paying no dividend at all. So until no dividend is paid, like let's say we are creating options for Tesla, then the option fee, the fair option fee, will be estimated at the same level, which is always funny for me, but yeah. But once there is any kind of payment, so it will be different in the case of currency options, for example, because you already have some kind of interest payment, and currency options are behaving like a share which pays you dividends because there is a payment, and after that you have to deal with that one. So at the level of functions, so in Matlab we are switching to another thing. So just saying now it's American option, and of course now it's not called Black-Scholes anymore, but there is another name which starts with G, I think. So yeah, and correct me if I'm wrong, but I think that there is no Heston for American options, so it's just for European options, or at least I was not able to see any Heston, but maybe we will see. So just I don't remember. Okay, and also there are different notations for the different positions if the price and the strike price, so actually market price and the strike price is related to each other. So at the money option is when we are at the same level at the strike price than in the market price. So practically in this case not so many things will happen because we are not hedging against anything. So in this case we were lucky to guess the outcome of the option. Out of money option means that the strike price is bigger than the actual market price. So in this case, if it's a call and I wanted to buy something, then I don't want to execute this one because I would buy at an expensive level compared to the actual market price. So I don't want to use this option anymore. And the same thing is valid for put option when we are under market price, because in this case I would like to sell my goods and why to do this through the option. But in the money option is when everything is happy and nice, and this is when it works to create the contract, because in this case we can earn some money. And this is when we can say that yeah, a call is creating a long. Just in the case of long contract, you have to buy the asset, sit on it, and then sell it. In the case of the call option, we can just get the right to buy. Then after that, we can put the money into a deposit or some interest-bearing asset until the option expires, so we can earn some money. And after that, we can see that, okay, are we out of money option, in the money option, and practically if we are doing it right, then we can earn back the option fee through the interest. So that was the basic logic of structured mutual funds or structured investments, at least one form of. So these are called sometimes guarantee funds or principal guaranteed funds. So unfortunately, zero interest environment killed most of them. Now they start to come back, luckily. That was the topic of our first article. Just it was in Hungarian, but yeah. We were hoping that so many citations will come for this one. Just unfortunately, since 2007 or 2008, nobody was writing any paper about structured funds in Hungary, so no citation arrived. We love them. this is what started my career as a researcher. Okay, so call option, put option, we were able to describe it, so I think it's not necessary. Also, in the case of options, only for short-term options there are no margin requirements. So if we are going above 9 months, in real life we have to provide also some initial and maintenance margin, and the threshold is 75%. So even in the case of options we have to pay to maintain the contract. Which is the right thing because still volatility is there. Just the problem is that we are already paying for volatility because this is a significant part of the entire options equation, and then we should still compensate the volatility. Okay, but my partner risk, I can understand this, but again, so that's why we have option fee to to deal with some of the partner risk. So it's so stupid. Okay, there is a reason why they are doing this, I can understand it, just come on, then in this case you are not trusting in your own equation. Of course not, because they went to default so many times, just yeah. Okay, so some short summary about the different margins here. So on short run there is no margin requirement, above 9 months there can be the 75%. Also, in the case of option seller, so who writes out the option? Who gets the money for collecting the option fee? So they have to put the following margin. So potential future liabilities and margin must be posted plus 100% of the value plus 20% of the share price minus out of money position, or in the case of call, 100% of the value and 10% of the share price, or in the case of put, 100% of value, 10% exercise price. So this is the strike price when it expires. I think this one is at least reasonable because if you are writing out an option that you would like to sell some stuff, at least the value should be included, that you have this, not just writing out because it's fun. And this part is okay, securing against excessive volatility, just again, that's why we have an equation. So yeah. Okay, and now it starts to become disgusting, so if I'm going back and forth you can see that which one is changing where. So now we have interest rate options. This is just for the OTC market, and in this case we can find swaptions, so we can write out swap contracts with an option built in. So practically it means that we are doing the trade between the two different partners, interest payments only under certain conditions. Which can be nice because maybe in most of the cases when the market is calm, it would be just generating transactional costs to move the money back and forth because they are quite the same, or they are quite boring, or they are too regular. And mostly we are creating this swaption contract because in this case we are securing ourselves when things starting to become non-regular. So that's why it's OTC again. So it's not for retail clients, and that's why we have this also these caps and floors. Which says that okay, it cannot go above or it cannot go under of certain levels, and also we can find this at the level of currency markets as well. So in many cases structured funds were mimicking what is popular on the market, because it was obviously if you are an investment banker and you have to step in to be one partner in an option, then you would like to trade away this kind of risk, so you are creating an opposite contract, and in many cases they sold this opposite kind of contracts, or at least they were recombining it to structured funds. So as an investor, I was able to say that, okay, my structured fund will provide me only profit if the Hungarian forint will go through a threshold, or in the opposite case, it will not go under a threshold. So in this case, it was absolutely clear that somebody needed such a contract, but after that, the service provider did not want it to run all these risks, so let's trade away some part of it. And especially these caps and floors can be really important. And if you remember the existence of the ceiling of the Swiss franc or ceiling of the Czech krona in the 2010s. Also, similar things happened that many hedge funds created these floors or caps contracts. Just the problem was that nobody expected that they will end immediately or suddenly, and this created huge losses and the failure of one of the biggest Hungarian. It was not investment bank because they never had banking license, so it was like a brokerage firm, hedge fund thingy combination. So it's I don't know what is the right term for Questor, but they were also falsifying their accounts, and they were doing it since the Russian crisis. So they were doing it for more than a decade, just nobody realized that. But once they were failing with this floored contract in Swiss franc, then after that they were the subject of a stress test from the National Bank, and then people realized from the National Bank that the books are falsified, so it was completely not related. Yeah. Okay, and Libor. So now we can see that Libor scandal was an important thing in the 2010s, in the early 2010s, because Libor was counted and calculated based on daily quotations, based on a query, instead of real market data with trades behind that. And since then, there was a huge variety of ideas that how can people change the London interbank market rate as a benchmark. And now we can see that there are completely different approaches. So sometimes they are always backed by actually trade data, so no random made up numbers anymore, like it happened in the case of Libor. But also at the same time, we can see that at least they are overnight. Also, they have to be wholesale. So you can see that 1 million euros interbank market, at least it's supposed to be wholesale. Money market brokers, they are also wholesale actors. Interbank market, okay, we mentioned it. Covered repos, so at least it's also it's overnight, so it must be really short term. And in most of the cases, the data provider is the central bank, except in the case of Switzerland. On the other hand, if we are checking the data basis, also we can see here Euribor, which is just the adaptation of the Libor just for the Eurozone. So also we should see here Esther and this Euro short-term rate. And even at the overnight levels, here and there, there is OIS Esther, yeah. But this is just one, and after that, for short or longer term periods, still Euribor is present. If we are checking, somehow I should turn on the underlying lag, but so anyway, the story is that people are always saying, or central banks are saying, that now they would like to close down the Libor benchmark, the usage of the Libor benchmark. Just at the same time, we can say that it's still in usage. So, okay, so derivatives. After vanilla, we can see also the non-traditional, non-vanilla derivatives. So these are the weather, oil, natural gas and electricity derivatives. So if you have any kind of company or especially university or city to run, then nowadays it can be useful to have such derivatives, because I know that only one Hungarian university had long-term electricity contracts and also natural gas contracts. That was the Corvinus University, and that's why they were absolutely not hit on, because they had 3-year contracts or something like this. And at that time, everybody was laughing on them that, oh, why do you need such a long position, and who cares about it? Yeah, there's a reason always. So. So Weather Risk Management Association provides us data, so even they have a website. They have report at least. Regional analysis, what are they doing? I mean, I was expecting to some Excel sheets and download button, but we got the Excel sheets. Regional analysis, okay. 2000 and January, let's view the report. Okay, this not so much. So we can have something for Europe. Anomalies, nice plus Celsius, yes. Right now the weather outside is spring. So even my petunia is still happily blooming. Well, now it's not blooming anymore, it's just growing. So yeah. So we can have data from this website. This is which is used by the industry, and practically they have two main indicators. One is this heating degree days, where they are taking the average highest and lowest temperatures during a day in uncultured Fahrenheit at a specific place. Why in Fahrenheit? Why? I know it's Desert Eagle plus freedom unit, but okay, so even NASA is using metric system. And in finance, which is supposed to be the top of everything, Fahrenheit. And after that, you can create a forward or option contract, and the payoff will be provided if you are reaching the cumulative monthly HDD or CDD, because also you can do this for cooling degree days. So what amount of energy do you need to cool down during the day, so for air conditioning, and also volume of energy required for heating during the day. So practically this is heating option. What we can see here, that okay, and typically this is what should be purchased by. So you know that in Szeged heat is provided by a company which is owned by the municipality. So they have this different heating center here and there, and after that they have to purchase a specified amount of natural gas. But they have to make the contract in the summer, and after that they are stuck there. And if they are not consuming enough, then even they are penalized by the wholesale trade partner, because practically they could just store natural gas somewhere, but they are not doing it. What they are doing, that if they are not able to use it for heating, then they are burning it and generating electricity. So I was in one of their power plants, and there are this huge what is this thing? Boilers. Yes, they are these huge boilers to create warm water, and also next to them there was an electric generator, so they can switch automatically that if there is no such a demand. But also they were transforming a majority of hot water generation to geothermal energy. And so they were drilling down a lot of wells, taking out the hot water from the soil, and it goes through some minerals. So it's like a bucket full of these small rocks to take away all the floating component from the water, and after that they are circulating inside some closed system, and after that pumping down if the temperature of the water reaches 20 Celsius. It's not really nice, just the problem is that when they created the contract for everything, nobody cared about it. So practically that was the pet project for several people, and they started to build up the project when I was a student. So it was a long time ago. And they were always talking about this. They were people from the geological department at the Faculty of Informatics and Natural Sciences. And now they were able to do this, and they were really happy. Just the pricing of the geothermal water is indexed to the natural gas price. So practically they were not hedging at all the natural gas pricing fee. They were hedging only the availability of natural gas. So if there is not enough, if there is no natural gas at all, but still there is electricity in the system, then they were able to maintain the heat. At least in my flat it would be 13 Celsius or something like this. So it's still moderate, but okay, it's not freezing on a cold day. But still they were penalized because they were not able to burn enough natural gas to generate electricity, because at the end of the day this winter was absolutely warm until today. So natural gas consumption is nowhere, and it means that they were penalized. After that, all these companies get some support from the government, because sooner or later, after several months, they realized that maybe politicians should do something. So now they abandon these penalties, because practically they were penalized by another state-owned company. So it's they were just taking money from here to Budapest. So that was the division of labor. But in this case, if someone has a weather derivative, and you can say that, okay, the heating degree days are way lower, then I can execute my option, and in this case, even if I get the penalty, I'm secured. So there are ways how to hedge out this position. Okay, natural gas derivatives. Practically, I think that they are cannot be considered as non-traditional derivatives anymore. So we can find spot rates at the markets. Mostly they are ICE market assets. So it's an OTC market, but it behaves like our usual exchange. So that's why data generation process is quite the same. But in this case, what is the tricky part, that natural gas usage is much more seasonal. So okay, for heating we are using it for winter, but you have to buffer in into the storage areas during the whole year. So you are buffering in, and after that you are using it in peak times. But this is also not the case, because if you are using it to create fertilizer, then you are using up natural gas during the summer time periods, because after that in autumn you have to put it into the soil. So, or at least during winter times. So So they are trying to balance out demand for natural gas. Also, natural gas is used by the chemical industry to create some kind of stuff from it, so it's to create plastics and I don't know what. So it's not just for heating purposes, what we can have here. And CMA group. So there are two. So there is the Chicago Merchandise Exchange, and there is also the Chicago Other Exchange. So I know that there are two CMOS. Yes. So, but always the CMA which is focusing on commodities. So if you are looking for some commodity data, then the CMA website or related database can provide you the things, and you can see here that physical delivery can be conducted at the same time. Just in this case, in the US, you have to do it in Louisiana. And also in the US, they are focusing much more on liquefied natural gas transport. Also, the same thing is valid completely for Japan or for Eastern Asian markets, where local natural gas production is missing or not so big or not so developed like in Europe, and you have a lot of different pipelines here and there, and some of them is coming from Russia or Central Asia, and also from Eastern Africa, because it's coming. There are pipelines towards Libya, towards Tunisia, towards Algeria. So yeah, I should not forget. Yeah. In the case of oil, so this is traditionally the commodity. So I like oil because you can proxy global growth expectations as well, because oil prices are always increasing or looking healthy if global GDP outlook is positive, but also obviously supply and demand shortages or shocks can affect oil prices as well. And just sometimes we are just adding them into regressions to smooth the model out, not just to model oil itself. Also, we can see that in many cases there can be fixed price contracts, and you can change these fixed price contracts to floating contracts, so it's behaving like a swap, maybe. And also, it can happen that we are swapping between two different kind of oils, so Brent and West Texas, because refineries are requiring one or the other, so you can convert them back and forth. Just the different sulfur content must be managed, otherwise the equipment will be harmed. And also, yeah, ICA trade, so this intercontinental exchange trade can be. Usually, we can find the data from Europe with ICA data, and from the US or from elsewhere, it's coming from the CMA. So that's the difference. If you can see the data somewhere, then it means that it's coming this way. Electricity is a different animal because we are not able to store it. So in the case of natural gas, we can build up storage facilities, or we can pump it down into depleted places, or in case of oil it's easier because it's not under pressure. So natural gas must be pressurized, otherwise it goes into places and explodes. In the case of electricity, right now, in the current state of the economy, it's quite hard to store. So that's why you have to balance out the whole grid real time. If you are not able to do that, then the hertz and voltage and other things start to fall to pieces, and then the grid is failing. So it's just a wholesale market. You are not able to go around. And also transmission capacity of the different lines is also a limiting factor. And And in the case of the United States, there are also big regions which are operating separately, except Texas, because Texas is completely separated from the rest of the grid. So a year ago, when they had this cold snap and everything was freezing completely in Texas, then other parts of the United States were not able to help them. So in the case of Europe, also the European Union is and neighboring countries are separated also at different geographical places. For example, Germany always tries to push their excessive green renewable electricity towards Czechia, towards Poland, towards southern countries. If they have something, so usually the excessive electricity is coming from the northern sea and goes down. So a lot of coal power plants must be shut down in Poland and elsewhere. So and usually if there is a blackout in Eastern Germany or Poland, then it's always coming because there is not enough transmission line, cross-border transmission line. So they are still a problem. But otherwise, you can operate in a nice way. So, for example, Hungarian consumption, I don't want to say stupid things, but 20% to 30% is coming from abroad. So we are importing a lot of electricity because other places can have. So we don't have so much raw materials or energy resources here. So only 1/3 of our consumption is supported from natural gas. So, for example, oil is even smaller. So, so it limits electricity. And of course, this is really important to the receivers. Also, a specified number of megawatt hours are defined at a specified price, a specified location during a specified month. And what can we do here? That we can have a maximum or minimum for the amount of power that must be purchased. So you can balance out the grid that by forcing someone that now you have to buy it because you have this contract. And that's why some companies are trying, or some startups are trying to step in this field. So, for example, if you are buying huge lithium batteries, or if you are building just stupid cranes and bringing up, so this is the gravity battery, or you are pumping up water on the top of a mountain, then letting it flow down. So this is the derivative side of such projects. Or you are just generating, so you are moving between hydrogen and water. So you are just separating water to hydrogen and then unifying them. And the problem of hydrogen that is absolutely corrosive and it tries to leak in all the possible ways which is possible. So lithium, at least you can put it there, and then after that, if it's not catches or not starts to burn, then otherwise it's quite inert. Yeah. Okay, exotic options. So what kind of options can we find if we are not just talking about European or American options? And there is a lot of things. So Asian options. So Asian options are providing a payoff based on the average price of the underlying asset during some specified time period. So we are not focusing on the dot or the spot price, but what happened in the average, which seems to be nice. Then barrier options came into existence or disappear when price reaches a certain barrier. So there are knockout levels. So it's like capping the market. Binary options, a fixed dollar payoff, a certain amount of underlying asset if some conditions is satisfied, so something happens. Okay, this is absolutely not defined. Look-back options. Payoff is based on the maximum or minimum price of the underlying asset over some period. So we have to check that, okay, was there any shocks in the background, then we are paying. So it could be, for example, related to temperature or natural gas price or something like this. Compound options, options on options. So call on call, call on put, put on call, put on put. We will not price this one, obviously. And basket options, portfolio. It's valid for on a portfolio of assets. So just for fun, let's check that. Wow. So if I'm just writing in Asian option into Matlab, prices European geometric Asian options during the Kemna-Wurst model. Noise. Yeah, binomial tree, okay, I can understand that one. So, even Asian options can be. Barrier option, do we have this one? Uh-huh. Yeah, so we will definitely try some of this. Yeah. So first of all, what are the challenges for us? So in case of risk management, we can say that the usage can be related to hedging. So this is what we used during the previous semester because we had this beautiful company and all of their exposure towards US dollars. Or it can be arbitrage, or it can be speculation because I would like to lock in the profit, hopefully. The problem can be that if we are misunderstanding something, so we are trying to hedge a position and it will be turning towards speculation. Or if we were thinking that we had an arbitrage and no, it was speculation at the end of the day. So when the underlying position related to the derivative is not stable, it can be an issue.